Okay, guys, good evening. Good evening for YouTubers, guys, and for the TikTokers also. So, we are waiting now for the news, guys. Okay, now we have a big news which is FOMC, guys. Okay, the sound is not working. Why? Hello. No. Okay, I can do it, guys. Hello, guys. Now I think it's okay. The voice is good on here also. Fine. Very good. Okay. Hello. Okay. Voice is good. Okay, guys. So 13 minutes remains for Fed interest rate, which is high important news, will make market so much volatile. So do not hold any positions, guys. While we have a news, do not hold any buy or sell. Okay, no buying, no selling, holding, guys. Ya bentar. If someone wants to hold the position, it's up to you, guys. But from me, I will not suggest anyone to hold any positions, guys. Why? Because market will be so much volatile. It is unnecessary to hold any positions while we have a news. Okay, so no holding positions. Technically, see, fundamentally we don't know. Now the expectation is what? The expectation rate is unchanged. Okay, the expectation rate is unchanged, 4.5% basis point. Possible there is no news that they will increase or they will decrease, reduce the interest rate, but anything can be possible, guys. Yeah, if it comes the same area, market will be in range bound. Then after 30 minutes, it will be very important to listen the press conference. Press conference will be crucial, guys. Yeah, press conference will be crucial because they will update about the US economy. They will update about the next plan for interest rate. So those will be very important. And hello sir, you may go to up. You mean go to up. राज भाई, मार्केट देखो, मार्केट जब न्यूज़ आएगी, मार्केट जो है ना काफ़ी वोलेटाइल होगी. ठीक है, वो रेट के डिसीजन पे डिपेंड करता है. टेक्निकली मार्केट ऊपर है, ठीक है, टेक्निकली मार्केट इज़ बुलिश, बट फंडामेंटली बिकॉज टुडे इज़ द डे ऑफ फंडामेंटल, गाइस, राइट. टुडे इज़ द डे ऑफ फेड. सो उसकी जो भी बात होगी उसके मुताबिक मार्केट मूव होगा. डेटा लो आया हुआ है. अभी डेटा लो की बात छोड़ दो, अभी 10 मिनट बाद जो है ना इंटरेस्ट रेट है, वो सबसे बड़ी न्यूज़ है. ठीक है, आल डेटा को छोड़ दो, जो गुजर गया, अभी की बात करो. अभी 10 मिनट बाद जो है ना इंटरेस्ट रेट है, वो आपने देखा नहीं होगा. ठीक है. So we will listen this news and listen the press conference also. First we will watch the Fed interest, that how much it will be same. Possible it will be same, yeah, but they can surprise also, right? For rate reduce, obviously they will not increase the rate, but they might be reduced, might be, yeah. 10 minute remains, and after 30 minutes of that we have a Fed press conference. We will listen that will be very important. ठीक है. उसके आधे घंटे बाद जो है ना हमारे पास 40 मिनट बाद, अभी से एक तो 10 मिनट बाद न्यूज़ है, फिर उसके बाद 40 मिनट बाद प्रेस कॉन्फ्रेंस है. दैट विल बी वेरी क्रूशियल. ठीक है. if it is not giving you a good move at FOMC rate, sorry, Fed interest rate, then the move will come at FOMC press conference. Okay guys, for TikTokers, for YouTubers, for both. Okay guys, so the Fed interest rate is coming within 6 to 7 minutes. Do not hold any positions guys. Market will be unnecessary volatile. Okay, so don't think, don't play, don't gamble in the market when we have a Fed news guys. Yeah, don't do that. That is unnecessary risk. Okay, if you place your stop loss, if you do a buy, if you do a sell, you place your stop loss, market will take your stop losses. So please don't do that, otherwise it's up to you. And still someone is asking bullish or bearish. Look at this, explaining everything but still asking bullish or bearish. When we have a Fed news, do not think any direction. If I give you the direction, you will go for buy, you will go for sell. Stay neutral. See, discipline is more important thing guys. Discipline says when we have a big news, stay neutral, out of the market. Yeah, out of the market. So don't ask me that bullish or bearish. Technically, if you see the 1 hour is daily candlestick is bullish. Yeah, that's technically 4 hour is also bullish. Okay, but again I'm telling you guys, market will move today, market will move on Fed interest rate, on FOMC press conference. Try to understand this thing. Yeah, when we have this kind of big news, technicals doesn't work. You have to stay out of the market. If you want to trade meanwhile, it's up to you. Yeah, but still, why I'm not deleting this one? Because it's technically okay, it's technically we have to watch it. If it goes downside, it will break. If it goes upside, it will respect the technicals, right? Three-minute remaining for the Fed interest rate, guys. Federal funds rate, 3 minutes. Boom. But last time market has not given a big move on Fed interest rate. Okay, if there is something new, something big, obviously market will move. Otherwise, there was a days, years and years back, when on every interest rate they were increasing the interest rate, right? Now they are reducing it. When on those times market was so much volatile, guys, so much volatile. Yeah, so 2 minute remains on Fed interest rate. Okay, guys. And it doesn't mean that today is the news, only today will move market. Yeah, possible that tomorrow morning at Tokyo session also market will give you a big move. So today will be the earthquake, tomorrow in the morning till evening also there will be aftershocks. So right, so aftershocks will be there. When I was new, I was also trading on FOMC. When there was a FOMC, I was buying, selling at the news time. And believe me, those days were a disaster day. Why? Because the more you spend your time in the market, you will understand that which time you have to stay aside from the market. You don't have to do anything, right? I have did so many mistakes. We learn from every day, guys. Yeah. Okay, the news came, guys. The news came. Let me see the news first. Look at the market move. Still good. Okay, the news is same, guys. Unchanged. No change on rate, guys. Unchanged. No change on interest rate. So unchanged, guys, and that was expected because there was no news, nothing that the interest rate will be changed. USD-JPY came down, dollar came down. Okay, euro, pound a little bit went upside. Okay, USD-JPY down, dollar down, euro up, pound up so far. Okay, but gold is still same. Technically, according to last 1 hour daily closing and 4 hour closing is good for upside technically, yeah. But the thing is, what when we have a big news like Fed interest rate or FOMC meeting minutes, press conference, then everything can be changed. See, 5-minute candle, the way it went upside, the way it came downside. Look at this. Okay, this is the dollar is still on weaker side. If today it goes upside, breaks this area, then it means dollar will be stronger. So possible that dollar will stay, it will come down, yeah. Technically we can't predict the news, we can't predict the economy, but yes, technically is the only thing we can predict the market, we can stay with the market. But the thing is, when we have a big news like Fed interest rate, on those times we just have to need to see the confirmations, technical confirmations, yeah. This is a 4 hour. 4 hour looks good for upside, but still from 3 days market is in the same range. Okay, the range is same, it has to break the area upside or downside. Right now the market range is downside 3370, upside 3400. Okay, so these are the range bound areas of the gold. Look at the last so many candles from 3 days, market is in the same range, little bit upside, little bit downside, that's it. Today will be very important to see the dollar. Dollar will be in green or in red, because at a very strong area, dollar at resistance area, and that channel, that bearish is from long time. If that area has been broken upside, then dollar will be bullish, otherwise dollar has a huge downside, yeah. There were days that at the FOMC the market was moving at this time, like it has just 5 minutes is gone, 500 pips already moved. There were days, yeah, when mostly the Fed interest rate was increasing. Now they are on the side of reducing the interest rate. Same quiet market, no big fluctuation, guys. Still this a small flag, bearish flag. At downside we have a bullish channel, right, and the upside we have a bearish flag. Okay, the downside, once it came at 70, that area was almost touched the flag as a bullish bottom area or support area of the channel, right? This area, this was the good support by structure wise, by trend line wise. Now it has to, if it touched again, this area will be the resistance. If it breaks, then possible good upside. Otherwise we have to listen the Fed press conference, yeah. This is the flag, see. Now from 3 days market is moving in a same range, no big movement, guys. Look at the dollar index. Dollar is index at the very strong resistance area, and if it comes downside it will come big, guys, yeah. This was the signal for USDJPY. Look at this, already we are in more than 50 pips, guys, yeah. The same signal was from yesterday. This was a buy signal for euro. This was a buy analysis for pound. Okay, and this was for a crude oil analysis because market was in range. Oh, this one, a crude oil. And the daily, if I show you daily, look at the daily. This structure of 4 hour looks good, looks fine. Now this is the daily, last daily. Look at this one, yeah. This was the resistance. This was the breakout, went upside, came down, respected. Then again yesterday came down, respected. Why? Because it has closed above the area. Now this is the third day. This is a doji kind of candle at the support area, so very good for upside, this one, right? This candle has to close above this area according to this one, right? But nobody knows about the FOMC. They can talk shit, they can do some surprises, that's why. Okay, again we can predict the market only by the technical ways, no fundamentals, yeah. That's why from 3 days we are in buy, not in sell, yeah. And I think on TikTok and YouTube people made a good money in this also, because many times it has given more than 100 pips, many times, whether it was in buy, whether it was in sell. But we were staying from 3 days in buy, not in sell, yeah. Almost the level was same. When the press conference starts, guys, we will listen the press conference also, yeah, live, and we will see how it reacts. Obviously market will react on a press conference. and this was a call for USD-JPY, sorry, JPP-JPY. Just missed this one. This was, and it came nice, guys, very nice. There was some disrespect here of the structure, but the trend line was good. That was a sell side divergence. See, this was the divergence. 1 2 3 4 touch points was a good touch point. Came down, closed below the area, and again downside. See, these things you have to learn, guys. Yeah, this is very important. That will be called a liquidity grab. And again, we are a day trader, not a scalping. We don't do trade on 5 minutes. We don't do trade on 1 minute. We don't trade on 15 minutes as well. Yeah, we take our direction. That is very important to understand. We take our direction from 4 hours, and we take our positions on 1 hour. Right? Sometimes we take confirmations from 15 minutes or 30 minutes, but mainly 4 hour and 1 hour. Yeah, so timing is huge. If you are continuously coming on YouTube or TikTok, so please understand this. Yeah, we don't change our analysis every time, like on a different content creators. Every time they are buying, every time they are selling, we don't do that. Now let me see on YouTube, is there any questions? No questions, because there was some disturbance on YouTube, so that's why. And my YouTube users, they are very experienced, guys. Yeah, as compared to TikTok users, because TikTok users are new. The more they will stay with me, the more they will understand my way of trading. There are thousands of creators. They trade on 1 minute, 5 minute, buying, selling, buying, selling, buying, selling, on every minute, on every 5 minutes. So, but I don't do that. Yeah. As well as we have learning classes also. We have a signals group also, and I have a very mature and a very good profile signal group members. Yeah. And they have an account of $100,000 account, $150,000 account, 50,000 accounts. Many couple of students, they have a couple of members, they have a 3 to 4 accounts of $50,000. Yeah. Most of them are trading on prop firms. Best signal provider and teacher. Thank you. She is the Patty from Switzerland, and one of the best trader, ex-student, and signal group member. She had taken a very good withdrawals, show so much improvement. So yes, on TikTok, guys, you can see this one. Yeah, so improvement, there is always a place for improvement, guys. Yeah, growing, the more we improve, the more we will grow, and that will be much better. Now, previously she was, do you have a live, do you do live here every day? Yes, Patty, every day from last 1 week, I think so, Patty, because I have checked it. There previously we had an issue. Yeah, I will share the link also. Okay, I will do that. Yeah, so the thing is what, previously we had an issue on a TikTok in Indonesia about forex trading or trading. So right now we don't have. Previously I was doing also a couple of years back, but that was banned. Now we can do live here, so that's why I'm daily coming online daily. It is almost more than 12 hours on TikTok also. Yeah, okay, I will share the link also. So yes guys, improvement, learning, only learning guys. Yeah, you are using signals, you are doing your own analysis, whatever you are doing, so but keep learning guys. At the end, once you got every learning technical strategy, the last thing you have to work on yourself. Petty will agree with this one. Yeah, you will work on your discipline. That is one of the hardest thing to do guys, working on discipline. Once you got a technical, once you got a strategy, everything, but at that time you need a discipline. That is one of the hardest thing. Okay, so I have shared the link of TikTok on Signal group also. Yeah, if someone wants to join. Okay. And most of the people, they are failing on their discipline, and most of the people are losing just because of discipline. How much you have to lose maximum, your limit of losing, your limit of making also profit. Once you are done with your profit, your strategy, you are staying with the market, out of the market, that will be very important guys. Yeah, for understanding this, all these are very important. Consistency, because with the good discipline only consistency can come. If you are not a disciplined guy, not a disciplined trader, consistency never will come guys, never, because all the time you will think that I will make some money, I will make some money. The more you will stay in the market, the more there will be a chance to be trapped. Now after 11 minutes we have a Fed chair Powell speech. Okay guys, and I will share the details also of signals if someone is interested, so they can join. But signal group will help you a lot guys. Yeah, for surviving in this market. If you are good with your technicals also, still you can join, but again this is a paid group, it's not a free group. Yeah, if someone needs any details of then you can send me a telegram message. Telegram is in my bio. Yeah, for TikTokers, for YouTubers, they knows my telegram. Or you can send me message on TikTok also, I will answer that. But yeah, investment to survive in this market is very important. Yeah, because if you are trading, if you are making, if you are losing, all these are Kalawa Tebza, it's a 200. One time payment, you don't have to pay every month, only one time. Yeah, and I have a users from years and years. Might be couple. No, no, it's USD. It's USD Kalawa. but that will not help you, not only help you to make profits, that will help you to learn also. Yeah, so take my signals as a learning side also. Yeah, because when we work on my signals, when I'm giving my signals with the charts, okay, see Petty also, she is also telling the same, worth every cent, you will make it back very fast. So she is the one who makes a very good amount of money. Last time she got a $26,000 payout from 2 different accounts, right? She's a good trader also, very much improvement, yeah, by the time she's improving a lot. But yeah, learning, she's a good learner also, that's why she's improving. Yeah, so the thing is, your money will not be wasted, that is my guarantee. Yeah, if there is no signal, then I will drop the analysis, right? And we discuss our analysis also, the problems also, the strategy also. It's USD. I think it's 200 is not a big amount, guys, for safety of your account. Yeah, but the thing is, again, in my signal group also, if you use a gambling, then nobody can help you. If you are a gambler means you are risking too much on a single trade, nobody can help you. My signals, any analysis there is, because signals are not a magic. Yeah, the winning percentage is good, the risk reward ratio is good, but still you have to manage your money. Which time frame? It's a 1 hour, it's written, bro. Rachel RSA, 1 hour. Already this setup also has given us many times, look at this, many times it came in our range, then upside, many times. And this is also only a one strategy, right? Where do we enter? The price also written. Recall, the price is also written. Yeah, not only one time but many time it came in our buying zone, guys. Yeah, I will watch it, the telegram message or TikTok message, if someone is interested, so they'll let me know. Recently the last one was Rajan from Malaysia. He has joined the signal group and he paid 200 for $1,000. He had a $1,000 account, means almost 20% of the account. Why? Because that is the for the safety of your account. Yeah, because I know that if you don't have any knowledge, if you don't have any good psychology about the trade, you will lose the $1,000 also. So is gold in buys in 1 hour, in 1 hour, in 4 hour, in daily candle, it's buy. MP. Now after 5 minutes we have a press conference, guys, from Mr. Powell. He will come and he will give the speech. Okay, so keep learning, always learning, guys. There are, if you cannot afford the classes, if you cannot afford the signals group, doesn't matter, you can learn from the YouTubes. You can download, there are thousands of ebooks, online ebooks, but the thing is to learn. Find a mentor. You must have one mentor. Whenever you get any problem about technicals, consult with him and ask the problem solved, moved on, and learning, guys. Yeah, now there are so many ex-students, still they are sending me the message if they get any issue about the technicals or even signal group members also. Have you already entered? Yes bro, many times, because this same analysis is from 3 days, from almost 3 days. Yeah, if someone is, there are so many users, they are coming daily here, so they knows it. Yeah, let me find FOMC analysis bro. Ranjit bhai, technically market is strong hai. Okay, Sushil says hello on YouTube, watching from UK. Okay, Sushil, welcome. आपका नाम सुशील है तो आप होंगे भी सुशील. ठीक है, आई एम होल्डिंग सिल्वर. ओके, so now I'm finding because we have so many messages on and a very good users on YouTube also. Yeah, I will open the mic now because it's time for FOMC meeting minutes, guys. Very important. I don't know you can hear me or not, but I will try it my best. Yeah, okay, I will try my best. Okay, okay, it means the both voice are there. Yeah, the press conference voice also and my voice also. Okay, within 2 minutes, guys. And after that market will give you a big moves, guys. Remember one thing, when we have a FOMC press conference, because the rate was unchanged, it means the press conference will move the market. So market move will be big, right? Technically market is, gold is strong, but anything is possible, depends on what Fed Chair Powell speech and gives you the details about the US economy, right? And we will stay with the technicals. If it breaks only this area, and if it gives you the 1 hour or 4 hour closing below this area, below this line, then only it will be bearish. Okay, and the area is 73. It has to close below 73 1 hour and 4 hour, then gold will be bearish. Otherwise 4 hour, otherwise daily is good for upside. And remember one thing, when we have a news like FOMC, technical is less, less working. Yeah, more fundamentals. What is the percentage of profit and loss if we trade on in 1 week? Mirza Pardesi, dur. See, my percentage of what? In my signal group or what? Mirza, तू तो पूरी जिंदगी तू परदेसी रहा है. तो दुर USD JPY सेल करके बैठा हुआ है. तो ऑफ कोर्स योर सिग्नल. सी, My signal ratio, especially in currencies, so good. Yeah, so good. Around 80% my signals, yeah, on signals, on currencies, but in gold it's little bit low, like 60 to 70%, but my risk reward is so good in gold. Okay, risk reward means RR. So it will be worth it for everyone, and you just joined it today, guys. Mirza has just joined today. Now he is asking. When he was trading in gold in Dubai, the price was around 500, 600, 700 per ounce. Okay, so I think it has started. Yes, it started, guys.
The interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about equipment and intangibles.
Press conference is going on, guys.
From weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March.
Bad.
In the labor market,
Bad for dollar.
have remained solid.
GDP bad for dollar.
35,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate.
Jobs are good.
Pacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March.
Unemployment is bad for dollar.
Its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year.
They will decrease.
The median projection declines to 3.6% at the end of next year, to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and, as I have noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effective tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more, and we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And our job is to make sure, one of our jobs, to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point of the year out of your projected path, and you end at a higher rate at 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path?
So I would focus most on the nearer term as you get out to the years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely, and then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that they do. So and that's actually a line from the Teal Book, which you can see in 5 years. Remember to check that. No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. It's uncertainty. So I think that's an accurate statement.
Thank you. Chris Regaber, Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5–2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But you know, we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the level where the labor market does or doesn't soften. And I think what you see people doing is looking at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts would be appropriate, and it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? Well, how many months does it take, and what do you want to see in the data to get that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn. In particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do, over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead, even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will show up. We have an estimate, and it's a pretty, all estimates are now pretty close to that, but it's highly uncertain.
When you say estimate, what is the impact of tariffs on the core PCE? Is that what it is? Can you share that?
Yeah, what you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff, but together they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict, and we haven't been through a situation like this, and I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. I'd like to get some more data, and in the meantime, we can do that because the economy is in solid condition.
Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down. It is time to look at resuming our normalization process. The differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty on the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
Well, if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient. That is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Thanks, Mr. Chairman. I guess with workplace rates picking up significantly, what kind of effect would that have on the labor market?
Sorry, with what picking up?
Workplace rates.
So you're asking immigration?
Yeah.
I wouldn't want to speculate. One way to get at that from an economic standpoint. We, of course, don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum. And that means, like, part of that is the labor demand and labor supply kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SCP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement, and we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into discussions about specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SCP is part of it. Many other ideas. It's sort of, how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was 2.5. Core PCE for 2025, the forecast was 2.5%, which is a good inflation forecast. I think what we've learned is that, this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought, and our forecasts are generally not particularly different from those of other well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming, and that would mean higher inflation. That's what happened. And so now you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, you consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, That's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past evidence. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
Follow up on that. So you spent years ago talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. I'm Mara Mokoy with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that Fed staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no. And I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we work hard. But I would say this: so we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're gonna show the public. We're gonna demonstrate that we are good stewards of public resources. So we thought, and I thought that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're gonna find 10% of employees who can do something else, where we can streamline operations, and we think we can get there in a year, in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps. It not just doesn't help the Fed. It helps the government. It helps Congress. It helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. the United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, well, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But that's not going to be up to me to decide.
Is that affecting at all you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation, and what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So of course we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but it tends to come down. Those things don't generally tend to have lasting effects on inflation, although of course in the 1970s they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but yeah.
Quick follow-up. I just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And we all see those announcements, including one today. I wouldn't, overread a couple of data points, because AI should be creating jobs at the same time. It may be replacing, it may be doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is, and it's just a different thing. So I think this is something that certainly has transformational potential, and probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive, and there are those who think it's going to replace an awful lot of jobs right across the income spectrum. White collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Market Watch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movement, so the dollar was impacting the economy. Are we going through something like that now? That are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. And it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. But you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack really. I mean, at the margin, remember you're at 4.2% unemployment. That was for many years that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. Also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken really over the last 3 years, and it's been remarkable to see just again and again when people think it's going to weaken. Now eventually it will, but we don't see signs of that now.
Go to Jean for the last question. Hi, Chair Powell. Jean Young with M&I Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people in the committee who wrote down no cuts this year, but some cuts next year. So I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, it's think of it as the least unlikely path in a situation like this where uncertainty is very high. I think again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people in the committee have. So thank you very much. Thanks.
Okay guys, so the press conference is done. Very good for the dollar. Jobs, housing, inflation, everything is good. Tariffs also, because it's cooling down, the tariffs issue. So all are good for the dollar, guys. And again, for TikTokers, for YouTubers, the dollar is going to be break its bearish channel. From long time the dollar was in bearish, now it's coming in bullish. Euro and pound, long time it was a bullish channel, now it's breaking for the bearish channel. So things will be very interesting for gold also, because if closes here gold, it means the downside breakout is done. For that we have to see the closing, right? And USDJPY also going upside. So things will be very interesting tomorrow. Yeah, very interesting. Okay. Okay guys, so so if today gold closes below 73, and that is pretty much possible, why? Because the dollar is strong, technically also. Yeah, if it closes here, because still we have almost 1.5 hours for closing of this market. If market closes around these areas, especially gold will be bearish, euro will be in bearish, pound will be in bearish, USDJPY will be bullish, dollar will be bullish. Okay guys, so this is the update about market, guys. Okay, for TikTokers, for YouTubers, for both. No, tomorrow if today gold closes here, tomorrow we will come in a sell position. Yeah, tomorrow will be the sell day. I don't know, Dancy is written in other language. I cannot understand this language. Okay guys, so I'm done for the day, for TikTok also, for YouTubers also. Yeah, so tomorrow we will do something. And as I told everyone before the FOMC, before Fed interest rate, that close your all positions at the news time. And that time market was at 91, 92, even it went to 94 also. We were in a good profit. So now look at this. This is the benefit. This is the benefit of when you don't hold any position while we have a big news. Otherwise the stop of gold was done, everything, stop loss is done, right? So now today we will we will wait for daily closing, right? Every news in a press conference was good for the dollar. End of this month, the interest rate will be reduced till 3.9, and till 2026 3.6. that is the projection of reducing interest rate for US. Okay, jobs, inflations, housing, tariff, everything was discussed, very good for the dollar in a press conference, right? So that's why the dollar is very strong right now. And if it closes here, dollar will go upside, currencies will come down along with the gold. Okay guys, so today is very important. So see you guys tomorrow. For TikTokers, YouTubers, should we hold on gold? No. Before also I have told everybody, do not hold any positions while we have a news. FOMC is a big news, right? Tomorrow morning you will see a big move in the morning in Tokyo session, right? So do not hold any position tonight also, and at the FOMC also. Only gamblers will trade at the FOMC, right? FOMC is to understand the dollar, the US economy, everything, right? At FOMC time, nobody goes for a trade because that will be too much risky, right? So see you guys tomorrow, TikToker, and it's almost more than 13 hours I'm online on a TikTok, more than 14 hours I'm on YouTube, guys. Yeah, feeling so much tight. And tomorrow I will see you guys. Okay, take care, good night, dada, bye bye. Thank you so much, guys.